Hey folks, another housing development burns down. Affordability starts deteriorating. Regulators start going after lenders to tackle this extended amortization issue, and the rising cost of debt is taking a bite out of consumers' consumption ability. All this and your questions and more on episode 136 of the Wise Old Owl Show. So another housing development goes up in smoke in Oakville. I believe it's a Mattamy site. And why is this starting to sound like a trend? You know, we had one in Vaughan, now another one in Oakville, and this is starting to get a little bit too concerning for me. I don't know what's going on, but hopefully an investigation is underway to point out exactly what it is. But on that note, one of the things that I want to point out is housing starts have plunged by 22.5% in May. We're on a 202,000 unit annualized number right now. The estimates were 240,000. So we're kind of behind the ball on the housing starts. And it's been the steepest drop since 2008, which is concerning. Most notably, the detached segment's taken the biggest hit. And what we're seeing is a record decline in permits. We're down 18% in new permits. And this is higher than when COVID started in April 2020, when permits dropped by 17%. So we're seeing a decline in permits at record levels. This is going to be a very, very concerning data point because construction accounts for 8% of all jobs in Canada. 8%. It's the largest segment that makes up the workforce. So if residential building remains in a slumping state, it's going to impact the GDP numbers. So as much as we saw GDP go up significantly, and it's what prompted the Bank of Canada to increase on June 7th, it could put a dent into it. So I always tell people, respect the lag. You have to respect the lag because these higher interest rates are starting to take their toll. And when you have prime rates at 6.95 and there's builders out there using operating facilities at prime plus type rates, it's not as attractive to build right now. So they're pulling back on their permits, they're pulling back on their new developments, and that means less homes being built. The construction industry could start seeing a slowdown in the very near future. And, you know, this is where the things start getting bad. As I mentioned, the third and fourth quarter are going to be very, very bumpy heading into 2024, and you have to be ready for it. Affordability is deteriorating. We're seeing rates go up again, okay? Fixed rates are still moving up. We had lender notices out this week that rates are going up again. To give you some perspective, last week we sat at 3.66% on the 5-year Canada bond yield. It's now up to 3.86, up 20 basis points in a week, okay? And just a month ago, we're sitting at 352. It popped right after the Bank of Canada hiked, and this is probably giving us an indication that we're probably going to see a further hike come July 12th. It's really causing quite a problem. And when I talk about affordability deteriorating, with higher rates, people are able to qualify for less, right? So that qualifying rate now is sitting at 7.5 range. Because the 5-year fixed rates, the 3, 4, 5-year rates are in that 5.5 range. So +2 on the stress test, they have to qualify at 7.5. They're able to qualify for less. It's creating a problem. And in our business, we're seeing 40% less transactions. The application flow has dried up for new purchases primarily. We're seeing an influx of refinances, restructuring, trying to figure out how to get access to some cash to get through the next little while. And the stress test is causing a lot of trouble for folks. It's become a situation where a lot of individuals are assessing how to deal with renewals, how to deal with accessing more cash, and they're having to go into the alternative lender market, the private market, to get access to money. So it's a real interesting situation, and one that we're going to continue to keep an eye on. And if there's anybody out there that does need a hand, we do have some great opportunities with some lenders that give you access to equity, and we could make them as flexible as possible. So if you do know anybody that needs a hand, give our office a call. We're always happy to help. And the regulator is starting to put some heat on the big banks about these extended amortizations. They're concerned that a majority of the portfolio has extended amortizations. Two lenders in particular, CIBC and BMO, allow negative amortizations, which is absolutely crazy if you think about it. So these scenarios, in these scenarios, what happens is you may start with a $100,000 mortgage, and because you're not making enough payment to cover the interest, your mortgage balance is going up. So you're actually going into negative amortization, not necessarily extended amortization. So nothing is being paid down of the principal. As a matter of fact, the interest is accumulating on the outstanding balance, and you're owing more than what you started with. And that's a real problem, and something the regulator, OSFI, wants these lenders to jump on quite quickly. So we're going to see how this plays out at renewal time, because what the regulator wants people to do is they want to have these lenders revert back to the original amortization, which means a couple things. Clients either have to make a huge lump sum payment to bring that amortization back in line, or they're going to see a large increase to their payment, okay? And this is starting to cause some problems. We're starting to see an increased number of listings in the marketplace. We're starting to see discretionary spending in household budgets impacted because the borrowing cost is taking up a bigger chunk than it used to, and it's really putting pressure on people. And before I get into what's happening on the credit card, line of credit, installment loan situation, what we're seeing is people starting to say, enough's enough. We've had enough. Maybe it's time to sell. And they're having that discussion. They're discussing these scenarios of maybe downsizing, changing the structure of the family unit by either adding units to their home, looking at other options of bringing family members into the home to live with them so they could participate in the debt load carrying. And it's really created some interesting situations. And what we try to do is we try to put all the options on the table to help our folks out, okay? We want to first try to see if they can stay in the home and look at all the avenues available to them to do just that. Whether it's adding a unit in the basement, finding a part-time job, seeing if they get overtime at work, seeing if they could rent out a room, okay? And we'll exhaust everything. Look at their savings, look at their budget. We go through their banking statements, their credit card statements to see if there's subscriptions, any type of annual fees that they don't necessarily need anymore, and just try to hone in on just what is required. The needs are focused on, and we try to get rid of all the wants. And through that exercise, believe it or not, we do find hundreds of dollars a month to help these folks stay in their home. But the key is you got to print up these statements. And we usually ask for 6 months bank statements, 6 months credit card statements, because when you are looking at these transactions on your phone, you're only really seeing the last 4 or 5, because the phone doesn't give you the full degree of transactions for that month. So printing them up and looking at them and seeing exactly what you're spending money on is a huge advantage. And we really drill down and help our clients out by finding opportunities to save some cash and free up some funds to cover some of these excess interest costs that they're incurring at renewal, whether they're in a variable or whatever the case may be. So it's an interesting time. We're doing our best to help people out, and we're seeing, hey, I'm driving around, a lot more garage sales out. I don't know if it's just garage sale season, but I don't know if you're finding that there's a lot more garage sales in the neighborhood. Let's go to the used Porsche tracker. Used car tracker. As you know, I do that every week, and we track how many used Porsches are for sale. And I look on autotrader.ca. I do a search of all used Porsches that are available within 100-kilometer radius of where I sit at Dufferin and Orphis. And this week it went up. We're sitting at 1,166 last week, pretty flat the last 2 weeks at 1,166, 1,168. It popped up to 1,190, so almost 24 more Porsches for sale this week than there were last week. So it's a little data point that we track to kind of get an idea of how many toys are starting to be shed by people. And you know, the Porsches are just one tool or one data point. I'm sure there's many more: ATVs, boats, Skidoos, all kinds of toys. And we're also seeing more cottages for sale in cottage country, right? So, you know, these interest rates are really starting to impact people's budgets. And let's think about where we were almost a year ago. You know, just over a year ago in March of 2022, our variable prime at the bank on your line of credit was sitting at 245 plus a half at 295. It's now at 745. It's gone up considerably, 450 basis points. And people coming up for renewal are having difficulty shopping for a new mortgage because the current mortgage they have, they don't even qualify for anymore because of the stress test. This is the last batch of mortgage clients from 5 years ago that are coming up for renewal that never had to deal with a stress test. Okay, so keep in mind that if you are coming up for renewal, you could be in for a big surprise. And it's very important that you know when you're up for renewal, do some research in advance so you can be prepared for what's coming. And we could definitely help you in that regard. So please reach out and we could help you with that. But, you know, we're seeing the toys shed. We're seeing people starting to scrape through all their savings, all their toys. The garage sales are happening. We're definitely seeing people trying to do their best. But here's some interesting stats from Equifax. So an Equifax report, an estimated 170,000 more consumers missed a payment at least once on a non-mortgage product. This is evidence that people are going to credit cards, lines of credits, any type of credit facility that they have, and they're not making payments on those facilities so they can make their mortgage payments. Because remember, the mortgage always gets paid first. But what we see is we start seeing the cracks in the credit card delinquency. We start seeing the cracks in installment loans being missed, lines of credit payments being missed. And one thing in particular that is evidence in BC and Ontario, okay, Equifax noted that the biggest year-over-year increase in 90-day delinquency is in BC and Ontario. And the rates are up 31.1 and 31.2% respectively in those two provinces. So in Ontario, the number of 90-day delinquencies on non-mortgage debt is up 31.2%. That is an indication of the cracks. This is clearly evidence that we're going to start seeing delinquencies coming to the mortgage portfolio. Now, with all due respect, mortgage portfolio delinquencies at its lowest. I think it's at 0.15%. I do think we could see it going up. Even if it doubles, it's still sitting at 0.3%. It's not a significant amount, but we might start seeing forced sales. People who have realized they've come to a point where they can't afford the home they're in, and we're going to see more listings coming up. We're already seeing it. We're seeing this increase in listings on MLS the last few weeks. We're not seeing as many bidding wars in the last week or so. And I'm telling you, that June 7th increase by the Bank of Canada caught a lot of people off guard. And it really created some concern about, whoa, I thought we're at the end, when it was just a pause. And people have selective listening. They don't necessarily always want to believe what is actually happening. But I tell everybody all the time, respect the lag. It takes time for all this to filter through. And now that we've come to a point where everybody's gone through their savings, they're racking up their credit cards and lines of credits, you got to pay the piper, okay? And now we're starting to see things break. And as I've told you on many episodes in the past, everybody's got to prepare for quarter 3 and 4. They're going to be ugly, they're not going to be fun, and it's going to be a tough time for everybody. Folks, want to thank you all for helping me achieve the 1,000 subscriber goal that I put out there on YouTube. We're almost at, I think, 1,200 or 1,300. So thank you to all of you for subscribing. If you're new to this, please hit the like, subscribe. I'd really appreciate it. So thank you very much to all of those that already have done so. I hope everybody had a great Father's Day last weekend, and I hope everybody can start enjoying the summer. Kids are finishing school, graduations are taking place at universities and colleges around. If you have somebody who's finished their degree or finished their certificate or diploma, congratulations. And please be kind to each other. If you have the ability and the resources to help somebody, please do so. Buy them a coffee, buy them a lunch, buy them dinner. And as you know, a few weeks ago, we held a charity softball game for Evangel Hall Mission. It is a homeless shelter that services homeless people, those in poverty, and those that are dealing with isolation. They're located at Adelaide and Bathurst area, and their Instagram page is EHM1913. Visit them. They have a link. You can make a donation. So if you have the opportunity to donate $5, $10, $25, please do so. You're doing it you're doing so for a great cause, and let's hope you could do that. Have a great weekend, enjoy the weather, and we'll see you next week. Take care.